We need your support. Click the like buttons below. Now onto the video. Welcome to readtheticker.com. Continuing our theme of studying simple moving averages. Here we have the crude oil weekly data going back to pre-war. And the 800 SMA keeps price above it when it is above. It keeps price down when it's below. And we have the odd breakout here. Break down, break up, break down. And now we're testing the 800 SMA, which is around the $69 mark. So I would consider the $69 and I would $79 mark, 71 as major resistance for the crude oil price, and to expect a correction or even a reversal. A breakout's possible, but it's less odds. Now let's consider the COT reports. Here we have barchart.com COT report. It's a weekly chart, 20 years. And here the first indicator we have, the green line is the speculators and the red line is the commercials. Now in the futures market there's two types of transactions. The speculator type transaction, which is someone who believes price is going up, they go long, and if somebody believes price is going down, they go short. That's well known to most traders. Now the other side of the market is the physical market. Now when a commercial wishes to sell their product onto the market, the commercial is actually creating a short contract, and when a refiner or a person who wishes to buy the oil, that's considered a long. Okay. Now we're focusing on the COT reports, which is a measure of the commercials. Okay, the physical side of the market. So the transaction we're looking at is when the commercials bring product to market and sell it to the market. That is actually a short. So like in any business, we have to consider your level of stock, the price you can get for it, and your price expectation you can get for it. Just like if you're selling umbrellas. If you hope to sell umbrellas in the winter, and you've got a bunch of them, and you want to get the best price, and you want to maintain the best price, the rain brings in the demand for umbrellas. Now you're not going to sell them all out as quickly as possible. You're going to try and hold your stock back to maintain the best average price. So you don't want to have too much umbrellas going to the market, otherwise the price will have to fall. So you release the umbrellas to the market and people will buy them, and they'll pay a premium. They'll pay $2 where in the summer they only pay $1. Okay. Now as the winter goes along, you're going to realise, well, you know, there's spring coming soon and nobody's going to need umbrellas as much. So you probably want to sell as many umbrellas as you can before the spring comes. So these are the stock issues you have to understand. It's the same with the oil business. The producers, their stock is in either two places. It's in the ground or it's in dry tankers on storage, or even in boats. So they can either slow production or increase production relative to price. So their expectations of price determine how much product they'll bring to market. Now the demand side is obviously, you know, the economy. It goes into a refinery and it's used in cars or what have you, and in the production of an industry, or it's large speculators buying the product and putting it in tankers and having it float around the Pacific. Oil is just like gold. It's a hedge against the dollar falling. It's a hedge against inflation. So if you believe, or you're really nervous about the US dollar falling, or you're really nervous about inflation, it's quite cheap to rent 10 tankers and have oil floating around the Pacific day in and day out, and ready to sell when prices are better, or prices are higher, and believe me, that goes on. Okay, so let's understand what this chart's telling us. Right, now let's focus on this price action here from the lows in 2009. Price rallied, it dipped, then it rallied again. Now this is the expected rally from the market fall, because obviously overextended. It dipped and it rallied again. This is the A, B, C wave. The C wave is the, oh my god, rally, I didn't believe it was going to happen type rally. Same sort of thing here. We've got a big sell-off. We've got an A, we've got a B, and we've got a C. Okay? So this thinking here to the businessman or the producers, the same thinking going on here. So what actually happened here is we have the commercials. Here we are down here in our first indicator box. Prices started to rise, so they started to release more product in the market. Now they're a bit gun shy from what happened with the sell-off, so they're quite keen to release production into the market. They've got bills to pay and what have you. Market slows down. They don't release so much to the market because they believe prices are higher. And then the price takes off. They can't believe their luck, so they're releasing as much product into the market as they can because their price goes from $70 all the way up to 110. So they say, I can't believe the prices. Let's pump that oil out of the ground, release our stocks, and get into the market and bank our profits. Now, the thing about oil, unlike anything else, it's just sitting in the ground. They don't have to buy different parts and manufacturing to manufacture a car or a phone or anything. They can just pump it out of the ground within a matter of weeks. It's in the refiners, ready to go. That's particularly the case of Saudi Arabia. Now, so the release of product into the market at these high prices because they can't believe their luck and they don't believe prices will be so good in the future, and they're correct because they accelerate the release of stock. Okay, slow release of stock, holding stock back, a faster release of stock. Prices attract stock into the market. Okay, if prices are that good, they're going to make so much money they're going to release stock faster. Same logic here. As you can see here, prices fell. You can see here they stopped releasing stock into the market. There may have been demand for it, they just didn't want to release the product. Obviously demand might have come off because of the fear of, World Armageddon and all whatever is going on here. But as you can see here, when prices started to recover, they started releasing stock into the market. So they're selling stock into the market, selling oil into the market, and that creates the short. So they accelerated that. Now what's very interesting here, prices slowed down, they stopped releasing stock in the market, and then prices accelerated. So like the ABC pattern and the market here, they really let go of the stock. They're selling stuff as fast as they can. Now the expectation here is, just like the expectation here is that they don't believe in the future that prices will be this good. So they're releasing as much stock as they can. They fear a price fall. Okay? Just like here, prices went up here, they expected that, but then prices really accelerated here. A really good C wave. They can't believe their luck, so they're unloading as much stock as they can, as they did down here, to bank the profits. Now, like I said before, as they got oil sitting in the ground, they can release it as fast as they want. If they believe prices are good, and if somebody wants to buy it, they're going to sell it. Okay? So this is just exactly like here. The psychology here of the producer is they can't believe the prices are so good, and they're releasing as much as they can to bank the profits. The bearish aspect of this is that if they believe prices are going to be much higher in the future, they wouldn't be so aggressive in releasing the stock. The fact that they are so aggressive in selling, creating the short in the physical transaction market, is that they doubt that the price will be higher in the future. Okay? So they expect prices to roll over and to moderate. That's why they're being so aggressive in selling or creating shorts. So in that sense, that is why this commercial short position is bearish. Okay, with that logic, let's go and look at the silver. Right, here we have the barchart.com silver weekly price action with the commercials. Now, we noted, let's note where the commercials go near zero. It's there, and over here at the bottom of there, and we're there again. Okay, once again, silver is a little bit more complicated production than oil because it's a offshoot of other production. Silver comes out of the production of gold and copper, and obviously it's dug out of the ground as well. So stocks are a little bit more complicated. You can hold stocks above ground, so it takes a bit of time to get it out of the ground and get it to market. So what we see here is that if people aren't really getting the stuff to market, like I said before, if people want to release their stock to markets, the commercial shorts increase because they believe prices are good, and if the red line falls back to zero, they either believe prices will be better in the future, or quite frankly they've got nothing to sell. Obviously prices will be higher because it's demand and supply shortage. But as we know, these markets are manipulated by the banks, so demand and supply is it's debatable. Okay, let's have a look. So at the moment, when the red line approaches zero, this was a good indicator of future higher prices. In this case here, with the red line approaches zero, it didn't look so good because the prices fell. They're expecting a bounce, but the bounce was not so good. So therefore, they had to release stock into the market because prices didn't recover. Now we're back down to the zero line again. Now, if the red line crosses the zero, what that means, the producers are actually buying the stuff. They're buying silver on the physical market because they believe prices. That's an aggressive situation. Okay, aggressive bullish situation, I should say. But they don't do that because they don't really have the facilities to store the stuff. So what does this mean here? Either they're expecting prices to rise. Well, they are expecting prices to rise. But as we know, the red line can stay at zero for some time. That means price can continue to go sideways for some more weeks before we get any price action. So the commercials do not see the benefit of selling their product on the market at the current prices. They expect better prices in the future. If they are wrong, it's like the situation here. If they're correct, it's like the situation here. Thanks very much for watching.